Right now, across the UK, people believe silver is getting more valuable, but what if the price you're paying has almost nothing to do with silver anymore? What if most of what you're handing over is not investment, but a hidden trap built into the system? Today, one single silver coin can cost over £100, and yet the same coin can be sold back for far less. So where is the money really going? Who is actually winning here, and why are so many new investors walking straight into it? Most people think they're buying silver, but they may really be buying something else entirely, and once you see it, you can't unsee it. The price illusion. Across the United Kingdom, a single ounce of silver was no longer being discussed in tens of pounds. It was now crossing into a psychological zone that historically belonged to gold. Over £100 for 1 ounce. In some cases, closer to 120. To the casual observer, this appeared to confirm a powerful story. Silver was entering a new era. Demand was rising, scarcity was real. The metal was finally being repriced. But beneath that headline number, a quieter reality was forming. What investors were paying was no longer a reflection of silver alone. It was the reflection of a structure. For decades, silver had lived in a narrow mental category. It was seen as an industrial metal, a hedge, a speculative asset, and for many, a physical store of value. Its price moved up and down, sometimes violently, but the act of buying silver remained relatively simple. A buyer paid close to spot price, added a modest premium, and took delivery. The metal's market behavior did most of the talking. That simplicity no longer existed. By the time silver crossed the $100 market retail, the composition of its price had changed. The visible number on the screen was no longer dominated by silver's intrinsic market value. It was dominated by layers built on top of it: taxes, premiums, demand surcharges, distribution constraints, risk buffers, inventory stress. The metal had not merely become more expensive, the system around it had. To understand the danger of this environment, one must first separate two prices that most buyers unconsciously merge into one. The first is spot price. This is the global reference price of silver as a traded commodity. It is where institutions, refiners, and large participants transact in volume. The second is retail price. This is what individuals pay when they purchase physical silver through dealers. Historically, these two prices moved closely. The retail price followed spot with a small and predictable gap. In the new silver environment, that gap had widened into a chasm. A buyer could now pay well over $100 for a coin whose underlying silver value was dramatically lower. The difference was not trivial. It was structural. In the UK, value-added tax alone created an immediate and irreversible cost layer. That tax was applied not only to the metal, but also to the dealer's premium. Every pound added before tax amplified the final price. This meant the moment silver entered a high-price regime, the tax burden expanded automatically. Without silver moving at all, the cost to acquire it rose aggressively. Then came the second force: dealer premiums. In times of normal supply and stable demand, premiums reflect minting, handling, and modest profit. In times of intense demand and strained logistics, premiums become defensive tools. Dealers raise them to slow order flow, protect inventory, and manage fulfillment risk. They are not pricing silver, they are pricing operational pressure. As demand for physical silver surged, those premiums swelled. They layered on top of taxes, which layered on top of spot. The result was not a market price. It was a composite figure built from scarcity perception, regulatory structure, and retail bottlenecks. The headline number rose, but the metal itself was no longer doing most of the work. This is where the price illusion begins. To the new investor, $117 per ounce sends a powerful message. It suggests maturity, legitimacy. It signals that silver has crossed into a higher tier of financial relevance. For entrepreneurs and business-minded individuals, such thresholds often trigger action. They imply confirmation. They imply safety. They imply that the asset has entered a new long-term valuation band. Yet illusionary prices are often the most dangerous ones, because they disguise what is actually being purchased. In this environment, a significant portion of every transaction was no longer exposure to silver, it was exposure to tax regimes, to dealer margin expansion, to logistics scarcity, to market friction. These elements do not rise with silver's future value. They do not compound. They do not appreciate. They sit. They widen spreads. They delay break-even points. They silently convert an investment into a consumption cost. This transformation alters the risk profile completely. In previous cycles, silver's volatility was the primary danger. Price could fall. Price could stagnate. Timing could be wrong. But structurally, entry efficiency remained intact. A buyer could exit without facing an enormous built-in penalty. In the new structure, that penalty existed immediately. Buyback prices lagged far below retail prices. The same dealers selling silver at historic highs were offering significantly lower prices to repurchase it. The spread between entry and exit had become severe. The spread represented not market movement, but friction. And friction is the invisible destroyer of capital cycles. For new participants entering at these levels, this meant something profound. Even if silver remained strong, even if the global price held steady, even if headlines stayed bullish, their position began deeply underwater. Not because the metal failed, but because the structure consumed the first phase of their capital. This is the silent failure point of many commodity manias. Losses do not begin when prices collapse. They begin when entry conditions are misread. In this phase of the silver market, many were not buying a metal. They were buying into a system whose primary beneficiaries were not future sellers, but present intermediaries. This did not mean silver itself lacked importance. On the contrary, industrial demand, monetary interest, and supply pressures were real. The metal remained strategically relevant, but strategic relevance does not protect against structural inefficiency. And structural inefficiency can destroy returns even inside correct macro theses. The greatest danger, therefore, was not silver falling. It was silver rising while investors failed to recognize that their capital was being diverted away from silver exposure and into layered cost. This is how bubbles often disguise themselves, not through euphoria, but through normalization. When abnormal pricing becomes familiar, it stops being questioned. When 117 becomes the new normal, few stop to ask how much of that number is actually silver, and that question marks the beginning of strategic awareness. Because when price stops reflecting substance, capital must shift from excitement to examination. Part 1 ends where serious analysis always begins, not with what something costs, but with what it truly represents. The structural cost trap. By the time silver crossed the $100 market retail, the market had already changed in a way most buyers did not fully recognize. This was no longer a price cycle. It was a cost cycle. In traditional commodity markets, price moves first. Costs follow slowly. Efficiency improves. Competition compresses margins. Over time, buyers benefit from scale. The modern silver retail market had inverted that logic. Here, costs were moving faster than the metal itself, and those costs were not optional. To understand why this mattered, one had to dismantle the modern silver transaction. Not emotionally, not ideologically, but mechanically. Every physical silver purchase now consisted of at least 5 layers. The first was spot price. This remained the global reference. It reflected institutional flows, industrial demand, monetary policy signals, and futures positioning. It was volatile, but transparent. The second layer was dealer premium. This had once been a narrow band. It now expanded and contracted based on inventory stress, shipping risk, mint capacity, and speculative pressure. In periods of demand shock, it behaved less like a service fee and more like a volatility buffer. The third layer was logistical cost. Transport insurance, secure storage, delayed fulfillment, and compliance overhead had quietly risen. These were not marketing points. They were embedded necessities of a physical market operating under strain. The fourth layer was taxation. In the United Kingdom and similar jurisdictions, this single element fundamentally altered the economic nature of silver. It did not function like a transaction fee. It functioned like a permanent capital impairment. Once paid, it did not participate in future price appreciation. It did not convert to liquidity. It existed only as loss that must be earned back. The fifth layer was demand distortion. When retail participation accelerates, pricing ceases to be purely economic. It becomes behavioral. Dealers are no longer responding to metal flows alone. They are responding to order velocity, fear cycles, and inventory run risk. By the time these 5 layers combined, the retail price of silver no longer represented a commodity. It represented a bottleneck. And bottlenecks monetize fear. This structural change produced a quiet but devastating effect, the compression of investor efficiency. In prior silver environments, small price movements could materially affect investor outcomes. A 10% rise mattered. A 20% rally was powerful, because most capital deployed actually touched the metal. In the new structure, early gains were consumed by friction. The first phase of appreciation no longer benefited the investor. It repaired the cost stack. This meant the break-even horizon stretched forward dramatically. Investors were not starting at zero. They were starting behind it. This shift did not merely affect returns. It altered time. When capital must first recover taxes, then premiums, then market spread, the duration of exposure lengthens. Liquidity becomes conditional. Opportunity cost rises. Strategic flexibility declines. For business-minded participants, this introduced a serious misalignment. Silver was increasingly marketed as an urgent acquisition, but structurally, it was becoming a long-term repair process. Urgency and long repair cycles rarely belong in the same instrument. Another dangerous dynamic emerged at the same time: the spread crisis. In normal commodity environments, buy and sell prices converge as volume rises. Competition compresses margins. Liquidity improves. Markets become more efficient. The physical silver retail market was moving in the opposite direction. As prices rose and demand intensified, buy prices accelerated upward faster than sellback prices. The gap between acquisition and liquidation widened. This gap did not signal opportunity. It signaled power imbalance. It meant intermediaries controlled the flow of inventory and pricing discovery. It meant risk was transferred away from dealers and onto holders. It meant the retail buyer was underwriting volatility without participating equally in price formation. This is characteristic of late-stage retail asset environments. The product is celebrated, the structure is ignored, and the structure quietly dictates outcomes. For entrepreneurs and aspiring businessmen observing this market, the warning was not that silver had no future. The warning was that silver's retail environment had become capital hostile. Not hostile to ownership, hostile to efficiency, hostile to turnover, hostile to tactical deployment. Capital entering the structure did not move freely. It entered a system that taxed movement, punished reversal, and rewarded only long-duration endurance. This made silver behave less like a tradable asset and more like a fixed project. And projects require planning. One of the clearest indicators of this structural shift was the normalization of extreme premiums. What would once have triggered resistance now triggered rationalization. High prices were attributed to strong demand. Long delays were reframed as healthy markets. Dealer margins were accepted as inevitabilities. Normalization is always the final stage before inefficiency becomes invisible. When inefficiency becomes invisible, most participants stop measuring it. And when inefficiency stops being measured, it becomes permanent. The danger of the modern silver market, therefore, was not excess. It was misclassification. Silver was still being treated psychologically as a simple metal purchase. In reality, it had become a layered financial product, and layered products always require structural analysis. Without that analysis, buyers risked entering not an asset cycle, but a margin machine. In such systems, the majority of capital does not fail dramatically. It decays quietly, through spreads, through time, through locked opportunity, through delayed exit. This is how sophisticated markets transfer wealth without headlines, not through collapse, but through architecture. By the end of this phase, one truth had become unavoidable. The question was no longer, is silver going up? The real question had become, who is silver going up for? And the answer depended far less on price charts than on the machinery surrounding them. The liquidity illusion. Every asset story begins with buying. Every real financial outcome ends with selling. Yet most participants in the silver market were being trained to think almost exclusively about entry. Charts, scarcity, headlines, retail shortages, new highs. These were the dominant narratives. They stimulated action. They justified urgency. They validated fear of missing out. But liquidity does not care about stories. Liquidity is mechanical. It answers only one question. How easily can capital leave without being punished? In the modern silver market, that question was becoming increasingly uncomfortable. The idea that physical silver is highly liquid had been repeated so often that it was accepted as fact. Silver coins could be sold anywhere. Dealers existed. Online platforms were active. Demand was strong. In theory, this meant holders were safe. In practice, liquidity had fragmented. It now existed in tiers. The first tier was dealer liquidity. This was the most visible and the most misleading. Dealers would always quote buyback prices. They would always advertise willingness to purchase. But these prices were not market prices. They were inventory management prices. They were designed to protect dealer margins and hedge operational risk. They were not designed to reflect retail demand strength. As retail prices rose, dealer buyback prices lagged. The gap widened. This meant the easiest exit was also the least rewarding. Liquidity existed, but it came at a steep cost. The second tier was peer-to-peer liquidity. Forums, private groups, social platforms, and collector networks began to absorb increasing volumes. These markets behaved differently. They reflected retail emotion more directly. They allowed higher pricing. They reduced some layers of friction. But they introduced new variables: trust, verification, counterparty risk, and execution uncertainty. These were not minor issues. They were the price of bypassing structure. The third tier was open marketplace liquidity, platforms where silver was no longer competing only with silver, but with attention. These environments could produce exceptional prices. They could also produce catastrophic losses, disputes, fraud, delays, capital lockups. In these spaces, liquidity was no longer a property of silver. It was a property of systems. And systems fail differently than markets. The emergence of these tiers signaled something important. Silver was no longer one market. It was several, and each one priced risk differently. This fragmentation created distortions. When retail prices at major dealers climbed aggressively, they anchored perception. They taught the public what silver was worth. Secondary markets began referencing those prices. Sellers adjusted expectations upward. Buyers compared offers not to spot, but to dealer shelves. This is how arbitrage windows form, not because value changes, but because reference points shift. Suddenly, it became possible to buy silver in one tier and sell it in another at substantial premiums. This did not occur because silver had suddenly become more productive. It occurred because price discovery had separated. One price reflected inventory constraint, another reflected tax burden, another reflected fear-driven demand, another reflected capital urgency. None of these were the same thing. This environment did not produce stable liquidity. It produced opportunity liquidity, and opportunity liquidity is volatile. It disappears when confidence shifts. It collapses when platforms tighten controls. It evaporates when disputes rise. It contracts when narratives cool. This meant that silver's most profitable exits were also its least reliable. For serious investors, this was a structural warning. Markets that rely on behavioral premiums for profitability are not markets. They are cycles, and cycles reverse faster than commodities. Another dynamic emerged quietly within this fragmentation. Silver began to exhibit characteristics of a quasi-retail financial instrument. Prices were no longer discovered primarily through institutional flows. They were being discovered through retail willingness, through what individuals would tolerate, through how much friction they would accept, through how long they would wait. This is a critical shift. Because retail willingness is elastic. It expands in excitement. It contracts in uncertainty. When that willingness contracts, secondary liquidity collapses first. The highest prices vanish. Then the peer networks thin. Finally, the only remaining liquidity is the dealer bid. And the dealer bid always reflects protection, not optimism. In such environments, the concept of silver demand becomes dangerously vague. Demand can exist at many prices, but liquidity exists only at one. The price capital accepts under stress. The modern silver market was being shaped increasingly by unstressed demand. That is not where exits occur. Exits occur when stress returns. The structural risk, therefore, was not simply price volatility. It was liquidity reversion. The risk that the silver market would not fall dramatically, but normalize. And when normalization occurs, premiums contract before prices do. Secondary markets cool before charts break. Retail exits slow before headlines change. This sequence traps those who entered through inflated structures. They are not wrong about silver. They are wrong about access. They assumed they owned a liquid asset. In reality, they owned a layered product whose liquidity depended on conditions outside the metal itself. This distinction matters because metals survive cycles. Structures do not. When structure shifts, exit paths close, not officially. Quietly, listings stagnate, offers decline, disputes rise, time to sale expands, and capital becomes patient not by choice, but by necessity. This is how liquidity illusions dissolve, not through collapse, through silence. The modern silver investor therefore faced a very different environment than previous generations. Not a simple buy, hold, sell arc, but a network of markets with unequal power, unequal protection, and unequal permanence. Understanding silver was no longer enough. One had to understand where silver lived and under what conditions it could leave. Because in a fragmented market, success is not determined by what something is worth. It is determined by where that worth can actually be realized. The strategic position. By the time silver entered the $100 retail era, the conversation around it had become loud. Scarcity, new paradigms, industrial demand, monetary hedging, retail shortages. But strategic capital does not move on volume. It moves on structure, and structure determines outcomes long before price does. For business-minded participants, silver's transformation demanded a different classification. It could no longer be treated as a simple physical commodity purchase. It had evolved into a layered financial exposure whose efficiency depended not only on macro direction, but on regulatory architecture, distribution mechanics, and market behavior. This shift did not remove silver's relevance. It redefined the conditions under which relevance could translate into returns. The central error forming across the market was conceptual. Many participants believed they were acquiring silver exposure. In reality, they were acquiring silver plus structure, and structure had become the dominant component. This mattered because structure does not compound, only the metal compounds. Taxes do not appreciate. Spreads do not rise with spot. Operational premiums do not belong to the holder. They belong to the system. Every strategic framework, therefore, had to begin with a single distinction: headline ownership versus effective exposure. Headline ownership referred to possessing silver. Effective exposure referred to how much of deployed capital actually tracked silver's future price movement. In the modern market, the difference between these two was expanding rapidly. For disciplined investors, this meant silver could no longer be evaluated in isolation. It had to be evaluated as part of an integrated capital plan. Three variables now dominated serious assessment. The first was efficiency. Efficiency measured how much silver exposure one obtained per unit of capital. It accounted for taxes, premiums, logistics, and exit friction. When efficiency declined, silver required larger price movements to justify the same deployment. This directly affected opportunity cost. Capital committed inefficiently is capital unavailable elsewhere. The second was time. High-friction assets extend holding periods by force. When spreads are wide, exits are delayed. When exits are delayed, capital flexibility disappears. This transforms an asset from a tactical position into a strategic lock. Lockups are acceptable when planned. They are destructive when accidental. The third was dependency. In fragmented markets, investors become dependent on specific liquidity channels, dealers, platforms, peer networks, regulatory environments. Each dependency adds risk unrelated to the metal itself. Strategic investors avoid stacking dependencies. They seek to reduce them. Within this framework, silver's role changed. It could still function as a long-term strategic metal. It could still function as a geopolitical hedge. It could still function as an industrial scarcity play. But it could no longer function as a simple retail accumulation product. The structure had become too heavy. This did not imply silver was over. It implied silver was entering a phase historically associated with late retail participation. In such phases, the asset often continues to rise, but participation becomes asymmetric. Those closest to the metal benefit from the metal. Those farthest from it finance the ecosystem. The distinction between these two groups is not belief, it is access. Strategic investors therefore began shifting focus away from price and toward indicators that actually governed outcomes. Not, is silver going up, but are spreads widening or compressing? Are premiums rising or normalizing? Are dealers accumulating or rationing? Is secondary liquidity expanding or slowing? Are regulatory costs stable or escalating? Is demand structural or narrative driven? These questions determine whether silver functions as an asset or as a retail product. The greatest risk of the $100 silver era was not collapse. It was misalignment. Capital misaligned with structure does not fail loudly. It fails quietly. Through long holds that were never intended, through exits that disappoint, through returns that lag expectations even when the thesis is correct. This is the signature of structural traps. They do not punish wrong ideas, they punish wrong entry conditions. The strategic position, therefore, was not to reject silver, nor was it to chase it. It was to contextualize it. Silver could not be the plan. It could only be part of one, a component inside a broader framework of capital deployment, business resilience, and long-term resource positioning. Those who treated silver as an isolated opportunity risked becoming absorbed into its retail mechanics. Those who treated silver as a strategic instrument maintained agency. They measured before moving. They assessed before accumulating. They valued flexibility as highly as conviction. In every market cycle, there is a moment when the asset stops being the primary story, and the system becomes it. This moment does not announce itself. It arrives disguised as excitement, as legitimacy, as normalization. The $100 silver era was such a moment. Silver had not simply risen. It had been enclosed by cost, by intermediaries, by regulatory layers, by behavioral pricing. Those enclosures would define the next phase far more than the metal itself. And this is why the central warning of this era was not about silver's future price. It was about the future conditions under which silver ownership could still serve capital rather than consume it. Because when the structure becomes heavier than the asset, investors no longer own exposure. They inherit obligations, and obligations are never assets. They are systems, and systems always extract before they reward.